The automotive market is on the brink of a massive collapse, with car prices expected to crash by 50% as the industry faces unprecedented challenges. The perfect storm of economic factors, rising interest rates, and market saturation has taken its toll on both new and used car dealerships. As the collapse begins, companies like Carvana and CarMax are struggling to stay afloat amidst the turmoil, and they are not the only ones that might go under. The collapse of the automotive market has been brewing for some time, fueled by a combination of factors that have created a perfect storm for a crash in car prices. Surging prices and sky-high interest rates have significantly reduced consumer demand for vehicles, while companies like Carvana have overexpanded their operations and taken on massive amounts of debt.
Seems like there's always something new and unexpected happening if you have not been following everything as it unfolds.
With used car prices already down 8.8% in the past year and further interest hikes expected in 2023, the pressure on the industry continues to mount. Another factor contributing to the crash in the decreasing availability of affordable financing options for car buyers. As the Federal Reserve raises rates to combat inflation, it has become increasingly difficult for Americans to commit to monthly payments for new and used vehicles. This has had particularly significant impact on the used car market, where buyers tend to have lower incomes and are more sensitive to rising interest rates. The decline in car prices is further exacerbated by the growing inventory of unsold vehicles, both new and used, as demand continues to wane. This oversupply has created a competitive environment where dealerships must lower their prices to attract buyers, driving the market collapse forward. As the auto market collapse gains momentum, industry giants like Carvana and CarMax are grappling with significant challenges that threaten their financial stability and long-term viability. The online used car dealer Carvana, known for its unique multi-story car vending machines, has experienced a staggering 95% decrease in share price over the last 12 months. Yes, you heard that right, 95%. This massive decline is attributed to a combination of surging prices, sky-high interest rates, and the company's overexpansion and overbuilding of its operations, which led to an accumulation of massive debt.
They will have to perhaps scale back some of their growth.
Carvana's financial numbers look particularly grim, with a 25% drop in profit per vehicle in 2022, total debt amounting to $9.25 billion, and only $650 million of cash on hand. Furthermore, the company recently reported a per-share loss of $2.67. Many analysts are now predicting that Carvana will go bankrupt, and media reports have emerged stating that creditors have already signed an agreement on how to handle negotiations with the company in the event of bankruptcy. This development does not bode well for the company's future. Although not in as dire a situation as Carvana, CarMax, another used car dealer with a more established presence and broader dealership network, has also taken a significant hit. Over the last year, CarMax's shares declined nearly 40%, indicating that even well-established companies are struggling to adapt to the rapidly changing used car market. The Virginia-based company, which operates nearly 250 dealerships across 41 US states, as well as an automotive financing unit, faces mounting challenges as the used car market continues to correct. CarMax's recent earnings report revealed some alarming figures. The company's earnings per share tumbled 85% compared to the same period a year earlier, falling well below the 64% that Wall Street analysts had expected. Additionally, its revenue fell 24% to $6.51 billion, and it reported selling 21% fewer vehicles in Q3 2022 compared to Q3 2021. While CarMax may not be on the verge of bankruptcy like its rival Carvana, the company's struggles serve as a stark reminder of the ongoing market correction and the need for businesses to adapt to the shifting landscape in order to survive. The substantial drop in used car prices and the persistence of high auto loan interest rates have combined to create a challenging environment for both consumers and businesses in the auto market. As the Federal Reserve continues to raise interest rates to combat inflation, the affordability of monthly payments for new and used vehicles has become increasingly difficult for many Americans. This has had particularly severe consequences for the used car market, as buyers in this segment tend to have lower incomes than new car customers, making them more sensitive to interest rate hikes. Moreover, auto loan interest rates for used vehicles are typically higher than those for new ones, further exacerbating the impact of the Fed's rates hikes on the used car market. As interest rates increased throughout 2022, the steepest declines in used car purchases were observed among lower income customers. This contributed to an estimated 10% annual decline in used car sales. Another factor weighing down used car sales is the improving new vehicle supply, which diverts some consumer demand away from the used market.
Working really closely with all the relevant parties to answer their questions.
According to Manheim Used Vehicle Value Index, wholesale used vehicle values, which are based on the prices dealers pay at auctions, fell by a record 14.9% last year. Cox Automotive forecasts that these values will decrease again this year by 4.3%. Although retail prices usually follow the trajectory of wholesale prices with a slight delay, the downward trend in used vehicle values is significant. It is crucial to note, however, that used vehicle values skyrocketed by a staggering 88% during the pandemic, and experts from Cox Automotive suggest that the current downtrend could reverse relatively soon, depending on the Fed's actions. As auto loan interest rates stabilize and decline in the future, lower prices are expected to create more affordable buying opportunities. This, in turn, should lead to more attainable monthly payments for consumers and help stimulate demand in the latter half of 2023. While the used car market faces a challenging road ahead, there is potential for recovery as interest rates and vehicle prices reach more manageable levels for consumers. As the market grapples with plummeting car prices and high interest rates, the outlook appears bleak for the industry. With used car prices expected to drop further, the ripple effects could be felt across the entire automotive sector, causing uncertainty and potential financial distress for car dealers, manufacturers, and consumers alike. The continued decline in used car prices may put additional pressure on dealerships, forcing them to reduce inventory and downsize operations in order to remain viable. This could lead to job losses and further consolidation within the industry as smaller, independent dealers struggle to compete with larger, more established players. Furthermore, if the Federal Reserve continues to aggressively raise interest rates, borrowing costs from both consumers and dealerships will increase, leading to a downward spiral in sales and profitability. Consumers may become increasingly hesitant to commit to monthly payments for new and used vehicles, leading to a prolonged slump in the market. Adding to the grim outlook, the possibility of a global economic slowdown looms large, which could exacerbate the challenges facing the auto industry. In such an environment, consumer spending may decline and access to credit could become more difficult, further dampening demand for vehicles. In summary, the auto market collapse is far from over, and the industry faces a daunting road ahead. With car prices set to crash further and uncertainty surrounding the economy and interest rates, the auto market may continue to struggle in the face of adversity, threatening the livelihood of dealers, manufacturers, and consumers. What do you think will happen in the auto market in the coming months and years? Will the decline in car prices continue, or will there be a rebound as the economy stabilizes and interest rates normalize? Share your thoughts and predictions in the comments below.